All right, going live. All right, we are going live, aren't we? Yeah, we are. Okay, we are live. Welcome back, ladies and gentlemen, to Ticker Time News. I am Adam. Thank you for joining me on such a nice day, wasn't it? It was pretty flat in the markets. No big swings up or down greatly, like 2 or 3% moves. No, none of those today. But some companies did. There were a few that moved certain sectors of the market, which were pretty good. A lot of it was defensive, though. A lot of today's plays were defensive. So remember, the most important thing about this is your questions. If you have a question, leave the ticker symbol and your question in the comments. We'll go over it live during the show. Okay, let's just kick this right off. The S&P 500 decreased 0.1% on Wednesday, as the market did a pretty good job mitigating the huge earnings disappointment of Netflix. Netflix, ticker symbol NFLX. Get my cursor on the right screen. NFLX did horrible, down 35.1%. Last time I checked, 35.1%. It is up 1/3% in the after hours, so some people are buying the dip on this. The Dow Jones was the outperformer on the day, gaining 0.7%, and the Russell 2000 climbed 0.2% as well. And I want to point out that the Dow stocks, those are your typical stocks that have been around for a while. Your Walmarts, your big conglomerates that have been there for a while. Those are your Dow stocks, and those are the ones that were up today. Defensive stocks. That's where people were going today, and that's what really helped the Dow out. Now, the Nasdaq, nothing helped that out. The Nasdaq fell 1.2%. Now, briefly, shares of Netflix tanked 35% after the company lost 200,000 global paid subscribers in this last quarter. 3 months, over 200,000 gone from the platform. And quite frankly, I don't blame them. There are so many streaming services out there right now. It's becoming a very crowded landscape, right? Everybody wants to have their own streaming service. And when that happens, it creates competition. So Netflix is looking to potentially add a cheaper tier that is partially ad supported. Netflix hasn't done that, right? They just keep taking their prices higher and higher and higher. Well, now they need to go on the opposite direction of that and bring their prices down and maybe serve up ads while you're watching that TV show or movie that you want to see, right? So that may be a possibility. Netflix also said that password sharing was a problem and they were going to crack down on that. We'll see how far that goes, right? Okay. Now, the first quarter. Netflix also projected that it would lose around 2 million subscribers this year. That's a lot. That's losing a lot of subscribers. Where are those subscribers going? Are they going to Disney Plus, for example? Disney keeps coming out with new and exciting content. Maybe. I can't wait to see where that puts Disney with the streaming service balance that we have going on. Where did these subscribers go? I know they didn't just poof disappear out of the streaming market altogether. They had to go somewhere. So whose numbers are up from Netflix's loss? We'll have to wait and see. Now, investors question Netflix growth story. That was a big one today. Everyone is thinking about Netflix and their growth. Do they have any more big growth? Or is it now just trying to maintain what they have? Is the positioning of the company going to change? And of course, many investors are bracing for similar disappointments in other streaming competitors like Disney. Ticker symbol DIS. Disney hit their 52-week low today of $124.11. Could some of Netflix losses slid over to Disney for this month, this quarter? It's so easy to sign up for a streaming service and then just dump it a month later after you're done binge watching whatever it is you wanted to watch, and then go to another service, pay for a month, and you can hop around that way. You know, that train may stop one day. We may have a big, circle back to the way cable used to be once the streaming is all figured out. But until then, there's money to be made, and there are areas that you have to be careful of. You can lose money. Just look at Zillow. Look at what happened to Netflix. It's happened twice now to Netflix. Big drops. But yeah, Disney falling to its 52-week low. Its earnings are about 21 days away. So could some of those streaming subscribers gone to Disney, or were they already at Disney and they just canceled their Netflix? This also brought up an interesting narrative of be careful with former high flyers. A good example would be Meta Platforms, ticker symbol FB. They were down over 7% today, nearly 8%. What is it? It ended 7.77% down today. Another big drop. They do seem to have fallen into support right here around that $200 mark. But it's not, incredibly strong. We sunk below it all through March here, many times, dipping below that $200 mark, but not getting any lower, really, than about $185 a share for Meta Platforms. Meta Platforms reports their earnings in 7 days. So the S&P 500 communication service sector, it dropped 4.1% amid that weakness in Netflix and other streamers and Meta Platforms, followed by smaller declines in consumer discretionary, down 1.4%, information technology down 0.1%, and the Vanguard Mega Cap Growth ETF, the ticker symbol is MGK. That fell 1.2%, 1.24%. Okay. So the mega cap growth stocks were not in favor today, and causing this ETF to drop 1.2%. Now, the broader market, though, it held up impressively well, evident by the gains of 8 of the 11 S&P 500 sectors. The roughly 2-to-1 advantage for advancing issues over declining issues at the New York Stock Exchange, and the Invesco S&P 500 Equal Weight ETF. The ticker symbol is RSP. Remember, you can follow along at home using TradingView. Every ticker symbol I look at, you can look at too. There is a link in the description to a free account for TradingView, and some other interesting bonus offers in the description as well if you want to take a look at those. And of course, you can help out the channel by clicking the first link in the description. Okay, so the Invesco S&P 500 Equal Weight ETF, ticker symbol RSP, it showed a 0.6% gain on the day. Now, granted, a closer look at today's market shows a defensive bias, with real estate gaining 1.9%, consumer staples 1.5%, healthcare 1.3%, and utilities up 0.8%. Those were your defensive sectors atop the sector standing. Now, the Treasury market also saw some relief today. We'll talk about that in a moment. But for now, Procter & Gamble, a couple of earnings here. PG is the ticker symbol. They were up about 2.7% today off of good earnings. They are back at the top of their trading channel. Could they go higher to get to this all-time high of $165? That has been a really, really, really important rejection resistance point for Procter & Gamble. So if you're trading this, take your profits. Because this area here, you're going to find a lot of resistance here. So you might find a lot of profit taking going on tomorrow for Procter & Gamble. But they look good for earnings today. Also, Abbott Labs, ticker symbol is ABT. They look good today, up 2.2% for their earnings. And again, they've been kind of range bound here going back to February. Finding support right around $115, and then resistance right here at that 200-day moving average. And as that 200-day moving average is just going along, it's finding resistance there right now. it's at $122 a share, and the 200-day moving average is at $124 a share. So just a couple dollars from that 200-day moving average, but they are making higher highs along the way, which is a positive sign. Also, Anthem, they came off with good earnings. Ticker symbol is ANTM. Another good earnings, strong report, and they have been in a really nice, really nice uptrend here for the year. I want to just take a peek here right quick. Year to date, where they sit, they're up 14.3% year to date. So they have beaten the market so far this year. And again, that's in healthcare, right? Healthcare is really doing a great job at beating the market for this year because it's a defensive play. Everybody needs healthcare, right? So keep an eye on Abbott. Great earnings for them again. And those, as a matter of fact, all three of the ones that I just talked about, from Procter & Gamble, Abbott Labs, and Anthem, they all supported the consumer staples and healthcare sectors following, of course, better than expected earnings reports. And then we come to the big old blue, right? Old blue, IBM. Ticker symbol is IBM. They were up nearly 7%. 7.1% is where they ended the day. How can an old school company, old school technology company like this jump 7%? They had fantastic earnings, and they jumped. They exceeded earnings expectations. So the defensive tilt might have also been attributed to a recognition that the S&P 500 remained below its 200-day moving average, which might have caused some investors to say, okay, we're at our top again before we go back down. And I've talked about this for a couple of weeks now, about the market moving sideways. I'm going to take volume off for a moment, but if you want to notice about volume right quick, volume is trending down, okay? Yesterday and today, volume did tick up from the holiday break, right? The Thursday and Monday. But overall, since almost the peak on March the 22nd, volume has been trending down, okay? RSI has been trending down. Money flows have been trending down, except for yesterday, I pointed out that there is a bit of a hook there at the bottom, like we may have found a short-term local bottom. And of course, being up yesterday helped to bring that up. But let me take volume away for just a moment, because here's what I was talking about. For the past couple of weeks, I've said that the market is going to go sideways for a while before the Fed comes out and changes its stance and becomes more dovish. Once the Fed becomes more dovish, that's when this market is going to new all-time highs. This third yellow box up at the top here, breaking 48.19 as a new all-time high. Once the Fed turns, the market's taking off, and that's where it's going to. So you know the signal to watch out for. Now, with this moving sideways, yesterday I told you that this line right here at 44.75, it was all important. It was a resistance line. And if we could get enough momentum to break above it, then we had to watch out for the 200-day moving average, because that could just drag everything right back down. And if we had enough momentum to break above the 200-day moving average, the next area would be up here at 45.80 to 45.90, that zone. And that would be a really tough resistance zone that I would be putting puts on the S&P if that happened, if it got up here, because then I think it's going down. Unless, of course, the Fed changes, right? So we hit this, and it's best looked at with the 5-minute chart, because you can really see this ping pong action today. Let's go back to first thing this morning, right? First thing this morning, just like yesterday morning, we have this big super rally in the morning, right? And then by 10:50 a.m., that was exactly the same time yesterday morning, 10:50 a.m., Eastern, that's when the market reached its top, right? And then it flattened out. And then we had a second burst, just like yesterday in the afternoon, a second burst. And then we ping-ponged up and below, above and below, above and below that trend line, or that resistance line, I should say, at 44.75. And we closed below it. So there's a good possibility we're heading lower tomorrow. Tomorrow could be a red day because we're now at the ceiling here. And when you become range bound, you hit your resistance, you go down to your support. You hit your support, you go up to your resistance. I mean, look at this. Over the past several sessions, it has been perfectly in between in this box right here. Hitting, about 4,400 even as support, and then 44.75 as resistance. So we could see a red day tomorrow and let this fall. So if we do break above it tomorrow, watch the 200-day moving average. It's at 44.97 right now. And as a reminder that economic activity is moderating, as noted by the April Beige book. And reporting indicates that New York City could soon up its COVID-19 alert level to medium risk. That would definitely slow it down. Now, in the Treasury market, the 2-year yield decreased 1 basis point. And again, you can look at that by going to US 02Y. That gets you your 2-year on TradingView. And you can see that decline. And it's come down a little bit there since after hours, but 2.57%. And then the 10-year yield decreased by 7 basis points. And you look at that by going to US 10Y, and that's your 10-year. So it decreased 7 basis points to 2.83%. Now, oil was pretty stable today, with the WTI crude futures increasing by 0.3% to $102 a barrel. Now, separately, you guys know that I've been talking about a slowing economy, especially in the second half of 2022. The strength that we saw in the Dow Jones Transportation Average, and the ticker symbol to look at that is DJTA. That takes you right there. It was up 1.7% today. Actually, it's up 2.7 right here on this chart on TradingView. Now, the strength that we saw in this today, because I talked about this in our Is Peak Inflation Good? Are we at peak inflation? And what's going to happen if we are at peak inflation? That video, I talked about this chart in particular, along with several other charts. If you haven't seen that video yet, I'll link it in the description of this video, so you can check that out when you have some time. It's very informative about inflation and our current market conditions. Now, this has been in a downtrend. You can go back to October 27th, but it really hit its high on November the 2nd, and it's in a downtrend. It's making lower lows, although right here, this little turnaround spot may be a sign that we want to look at. Maybe. It could be the beginnings of maybe something turning around. Maybe. But the strength that we saw in the Dow Jones Transportation Average today was largely due to a 12% gain in the highest price component in the Dow, and that's Avis Budget. Ticker symbol is CAR. Now, real quick, the reason the Dow Jones Transportation Average is so important for understanding where the economy is going is because this is a leading indicator, okay? A leading indicator. It's not like a recession indicator, right? We don't know that we're in a recession until, oh, we're already in a recession, because that's a lagging indicator. This is a leading indicator, and it lets us know what's about to transpire, okay? So this downtrend, it just shows that we're in a slowing economy. Now, let's go look at Avis, ticker symbol CAR, C-A-R. Now, Avis was, in this whole big old 11.94% is what it ended up being today. This big 12% jump today was all because Avis was upgraded to equal weight from underweight at Barclays. Yeah. So it got an upgrade and it just shot up 12%. Bang, there you go. And since it is the highest price component in the Dow Jones Transportation Index there, that's what moved that index so big today. Now, economic data pointed to the housing market today. The economic data that we got. Existing home sales decreased. Existing home sales decreased 2.7% month over month in March. And we had a decrease last month in February. Now, this works out to a seasonally adjusted annual rate of 5.77 million units. Now, total sales in March were down 4.5% from a year ago. The key takeaway from this report is that the supply of available homes for sale remains extremely tight. Yet higher mortgage rates and higher inflation are contributing to a slowdown in demand, all rooted in affordability pressures that are expected to persist throughout this year. I told all of you yesterday that my family and I are now among the other Americans that have been priced out of the housing market. We've been looking to buy a new home, used home, buy a home, make it our own for months now. And, me being in the wheelchair, it it makes finding the right home a little bit trickier. But we're officially priced out of the market right now. So we're among the millions of Americans who have been priced out of the market due to interest rates going up because of inflation going up and fears of a recession and a slowing economy. All of those things contributed to pricing us out of the market. We're here in Northern Virginia, which is, Northern Virginia is kind of in its own little bubble because there's a lot of government workers in Northern Virginia. So it's the economy here is pretty steady compared to other places around the country. Let me know in the comments below, how's the economy in your part of the world? But here in Northern Virginia, it's in a little bit of its own bubble. And not bubble as in, prices are inflating and it's going to blow. It's kind of like its own little, what's the words used? It's escaping my mind. But it's like its own little region, plenty of government workers, not a lot of fear of people losing jobs in this area, even though it does happen when the government does, have to make cuts. But, big military base here. Big military base to the south in Norfolk and Virginia Beach, and a lot of traveling between Northern Virginia and southern Eastern Virginia there. So there's a lot of traffic in this area, so it's pretty stable compared to other regions in the United States. So prices have gone up. They've continued to go up. Interest rates have gone up. With interest rates going up and inflation both going up, that's what basically priced us out of being able to buy a home right now. So it's unfortunate, kids are sad about it, but what can you do? You just got to roll with the punches. So yeah, that's the situation. That's why I'm making these YouTube videos, to share this information that I have with you, to help all of us, help you, help me, help everyone reach financial freedom, because it is so important. And it should be taught in schools, just the basics about financial freedom. I'm a big believer in teaching kids to be financially free. So when they're young adults, they have a path, at least financially. They know where they should be going step by step by step. And, it's kind of like a roadmap laid out for them that they can follow. Of course, they can go down their own path and find, new and interesting ways of doing things. But, at least they have some sort of a roadmap to follow there, financially, that is. So that's why I pour my heart into, these videos to share the information that I can with everybody. Okay, next up, the MBA weekly application index. We got that like we do every week, and it decreased 5%. 5%. It was down 1.3% a week ago, and now it's down 5% today from last week. So that, again, is showing the housing market is starting to slow down. The housing market bubble, think of it as a balloon, is starting to deflate right now before our eyes, as millions of Americans are being priced out of the housing market. So, these big price increases that we've seen in the housing market, they're going to start getting to a reflection point in the growth, the value of these homes. They're going to start, instead of going like boom, and they've gone up a big chunk in a year, they're going to start going slower and slower, and maybe float back down a little bit. Maybe in 2023 they'll float back down a little bit and get a little more under control. At least that's what I'm hoping for, so we can take another shot at buying a home, right? Okay, looking ahead to tomorrow, economic data-wise, investors will receive the weekly initial and continuing claims, the Philadelphia Fed Index for April, and the leading economic index for March will all be released tomorrow. Now, let's talk about the big earnings behemoth. Let's talk about Tesla. TSLA, and then we'll wrap this up. But I do want to talk about Tesla because they had their earnings come out. They're up 5% now in the after hours. I knew Tesla would do good today. Let me get the volume back on here. So volume's actually been going down for Tesla since April the 12th, so not too many sessions. And it's really been riding this 21-day moving average as resistance since April 11th. But this earnings should give it a nice little bump and potentially get it back above it. Now, they were down nearly 5% during the regular session, up 5.4% in the after hours. So Tesla beat by 95 cents. They also beat on revenue, and they reiterated expectations to achieve 50% average annual growth in deliveries over a multi-year horizon, which was awesome. Now, they reported their Q1 earnings. They came in at $3.22 per share, 95 cents better than expected. And revenue, that rose 80.5% year over year to $18.76 billion. The estimate was $17.8 billion. So again, a great job overcoming that. The automotive gross margin of 32.9%. That was up 636 basis points year over year. Total production, 305,407 vehicles, up 69%. Total deliveries of 310,048, and that was up 68% year over year. Expansion of their production capacity, they say, is their core, the core thing in decision making. Now, over the past 2 months for Tesla, they believe that, or they don't believe, they have begun delivery of Model Y from Gigafactory Texas and Gigafactory Berlin. And it doesn't make much of a impact on Q1 gross profit or anything like that at this time. It wasn't that many, but it will be moving forward. Now, at the same time, they are putting significant efforts into in-house cell production, raw material procurement, and supply diversification. Now, the outlook, this is what Tesla said, quote, We plan to grow our manufacturing capacity as quickly as possible over a multi-year horizon. We expect to achieve 50% average annual growth in vehicle deliveries. The rate of growth will depend on our equipment capacity, operational efficiency, and the capacity and stability of the supply chain. Our own factories have been running below capacity for several quarters as supply chain became the major limiting factor, which is likely to continue through the rest of 2022. End quote. That is what Tesla has to say. Now, we can read a few things out of that. Number one, running at below capacity for several quarters, that means they could have produced and delivered more vehicles. They could have done that if they weren't limited. Just think, the Shanghai gigafactory had been shut down in China. So it's very interesting. And this is something we knew last quarter too. They let us know last quarter that they were not running at full capacity. Now, they plan to grow their manufacturing capacity as quickly as possible. You know what that means to me? What I hear is Tesla has figured out how to build the perfect factory. And they're going to take Gigafactory Austin, and they're going to copy and paste that factory everywhere that they can. Maybe India, maybe another one in Europe, maybe another one in the United States, maybe one in South America. Who knows? Maybe another one in China. But building capacity as quickly as possible, to me, means they're going to copy and paste Gigafactory Austin all over the planet and build as many as they possibly can and as quickly as they can. And then the next part, over the multi-year horizon, they expect to achieve 50% average annual growth in vehicle deliveries. Well, you can't keep up growth of 50% in vehicle deliveries unless you are producing and building more factories. So, where do you think the next gigafactory from Tesla will be built? Let me know in the comments below where you believe that will be. That will be a really good and fun thought exercise on where the right place might be for Tesla to build its next one. Okay, and then they said about the rate of growth, it will depend on the equipment capacity, operational efficiency, and of course the efficiency and capacity and stability of the supply chain. So as they're building more factories, right, they want those factories to be built as close to the raw materials and of course to the customers as possible. Because Austin, Texas, that gigafactory, they're taking in raw material and on the other end spitting out a new Tesla. So that is great news for Tesla. You know, and then, you know, they also talked about their own factories, and I already mentioned this, so I don't want to, you know, rehash it, about not running at full capacity for several quarters. Once they do that, can you imagine how many vehicles Tesla will be able to produce? It's just insane, the amount, and how it's a huge limiting factor. The supply chain. That's why they want to build factories, and I think they're going to cut and paste the Gigafactory Austin someplace that's close to raw materials that they need, and then also close to the end consumer, somewhere in the middle. So they take in the raw material, they build the battery, the car, and out pops the Tesla on the other end, going to the consumer. That's what I could see for Tesla. Now, I'm going to be very interested in reading the transcript from their call, since I'm not listening to it right at this moment. And of course, we'll talk about any other stuff coming up. I do have a video coming out on Johnson & Johnson. They had an earnings that was mixed. It was mixed. There were some positive signs in there, and the spinoff that's happening could create a positive catalyst for J&J. So I have a video on them coming out. I also have a video on Netflix and the disaster that it was, and what that means for other streamers that you can watch out for. So watch out for, make sure you are subscribed and click that notification bell so you get notified when those videos come out. Again, Johnson & Johnson, Netflix, those videos are coming out soon. If you like my perspective, if you like the work we do, then you can help us out greatly by smashing that like button, sharing this video, and clicking the first link in the description to join us in beating the market. I know it may sound cliche, but it helps the channel, and we give you a guide, I guess I would call it, on where to look in the market for different types of stocks. So it's very beneficial. We've gotten lots of good feedback from it. So click the first link in the description to take advantage of that. And that'll wrap it up for now. Thank you so very much for watching, and I will see you in the next video.